Hello, I'm Pat O'Hare, Chief Market Analyst for Briefing.com. Today is Tuesday, September 2nd, and in his latest Big Picture installment, Briefing.com CEO Dick Green takes a look at what the stock market view will be 2 months from now. In the piece, he writes, "Summer is over. This much we know with the passing of the Labor Day holiday. The historically difficult period for the market is not, however. Yet, in 2 months, perceptions of the fundamentals could be substantially improved. That could set the stage for a solid year-end rally. 2 months from now, there's a very real possibility that 1, it finally becomes recognized that the U.S. economy is growing at a decent pace, 2, that the inflation outlook is significantly improved, and 3, that the earnings outlook is viewed much more favorably. Instead of driving by looking in the rearview mirror at the horror of the housing debacle, the market may finally start to look forward to a more optimistic 2009. It must be noted that September and October have historically been difficult months for the stock market, but this year the fundamentals will fall into place by November, adding to the prospect of a year-end rally. The announcement last week that second quarter real GDP rose at a 3.3% annual rate did little to quiet the economic bears. The very same economists who have bombastically forecast a recession and declines in real GDP for both the first and second quarter are now saying that the weakness will finally be evident in the third and fourth quarter numbers. The only problem is that they will be very wrong yet again. The trends in the components suggest that third quarter real GDP will post a gain of 2.5% and perhaps much higher. There just isn't any evidence of a consumer-led recession or a contraction in business investment. The next 2 CPI numbers, meanwhile, are likely to be negative. This will obviously help inflation perceptions. By the time the September CPI is reported in mid-October, inflation concerns could have eased substantially. Optimism will be tempered by the ever-present possibility of rising commodity prices, but a cooling of demand due to slower global economic growth should keep fears in check. The biggest surprise could come from improved earnings expectations over the next 2 months. Forecasts for the third quarter are for earnings, excluding the financial sector, to be up 11% in the third quarter and up 14% in the fourth quarter. Those forecasts may be optimistic, but they show that the earnings problem lies in the financial sector and that there is indeed underlying earnings growth. Looking into 2009 then, the outlook for earnings could appear much, much better. The shift in earnings expectations will lead to some very impressive value considerations. At its current level, the S&P 500 is at a forward-looking PE of just 12. As soon as it becomes accepted that the worst of the write-offs are over, which may happen with the third quarter financial earnings reports in mid-October, the overall market will reflect very good value. Dick concludes in his piece by pointing out that the sound investing requires anticipating the changes in market perceptions that could occur. The fundamentals are improving relative to current perceptions, he says. There will be greater recognition of this over the next 2 months. It is time to start thinking about positioning for a year-end rally and an improved outlook for 2009. For this week's full Big Picture column, place your cursor on the Our View tab at the top of the page and select the Big Picture, which is the 4th page listed on the drop-down menu. I'm Pat O'Hare for Dick Green and Briefing.com. Thanks for listening.